Hey everybody, it's Craig Moser. It is October the 11th. Man, this year has flown by, and wanted to give you some charts and a brief market view so we can have a understanding of what we feel like is happening here in the US and abroad. A lot is happening geopolitically, a lot is happening obviously in the United States from a political standpoint, a lot of stuff. And so wanted to share at least what the markets are doing, um, so that we have a good view as we see it in the future. Now, if you need to talk to us or if you need some questions answered, feel free to call us. It's 336-448-1086, or you can shoot me an email at Craig, Craig, at maestrowealth.com. So let's dig in here and take a look using a new charting program. So forgive me if I'm a little weak with it, but I'll get better as we practice more and more with it. Okay, so let me give you what you're looking at. This line that changes color, okay, is really the discussion in every one of my upcoming screens. So this is volume, this is moving average, convergence, divergence, yada, yada, yada. We're just looking at the pricing of it right now. All right, so what's up happens to be gold. People tend to flock to gold when they're a little nervous with the way the world's going or maybe the economy's going. But you can see, and again, I'm looking back 5 years. So 5 years ago, gold was here. 2020, gold was here. 2022, gold was here. And it's just sort of a sideways churn for the commodity gold. And this is the SPDRs, Standard & Poor's Depository Receipts, gold shares. Then that's my proxy for that. So you'd move this decimal over one. 1735.80 is about what an ounce of gold is right now today. So if you look at this and say, kind of sideways, no dividend, there's no earnings on a piece of metal. So, that's where gold is if that's something that interests you. All right, as we look at what everybody tends to want to call the stock market, here is the Standard & Poor's 500 index. So again, we're looking back in the window 5 years. So that was a downturn. I think that was 2018. Here is COVID. Big run up when they printed a bunch of money, and pretty much a climax as to where the stock market was at the end of 2021. About a 27% decline, and then a work back to this point right here. So we are well off the highs of the end of 2021, but have recovered off the lows of about this time last year. So the market is sideways, not really doing anything, but I mean, if you watch the TV, it sounds great. So in this index, you have sort of a combination of the Dow Jones. So most all of those stocks are in the S&P. And additionally, the combination of a lot of really good technology stocks as well. That you've heard the Magnificent Seven and all that. All of them are in this S&P 500, which in part is responsible for this fairly good rally. Those are, the buzz was artificial intelligence, but it's been pretty cool to watch. If you look at the Dow, it looks kind of the same. The Dow had a decline, but not as bad as the S&P because it didn't hold as much NASDAQ type stocks sideways really for quite some time. So if you're trying to figure out where we are, where we were, say, in the 2021 range, really haven't made much headway. But depending on which TV station you listen to, it sounds different. NASDAQ. So this is the whole shebang in NASDAQ, not just the top 100. So COVID, big run, big decline, about 35% actually, and now has marched itself back up to where we were, October of 2021, maybe 2 years ago. So again, if you bought the NASDAQ as an index through Vanguard or whoever you use, you're just kind of treading water and hoping you get back to where you were and to start to make the move up to the upside. All right, and I'll do one more just for the fun of it. NASDAQ 100, which is kind of the best of the best in NASDAQ, and all of those top stocks, Apple, Microsoft, Google, Meta, all of those guys are in this index right here, the top 100 of NASDAQ. Very good index. But once again, we're about where we were, I don't know, somewhere in 2021. Haven't really made new highs. All right, let's look at the bond market. Well, let's don't do that yet. Let's look at the developed international world, except for the United States. The US is not in this index, and I'm using BlackRock's Europe, Australia, and the Far East Index ETF, IEFA, or for EFI. All right, so if you look back 5 years, COVID, similar chart pattern, similar climax sell, and again sideways. So looking back to where we were, not at the highs, but back around where we were maybe August of 2021, just sideways. Nothing great or bad, just sort of ho-hum, and you have to really work hard to try to make some money, especially if you're doing an indexing strategy here. All right, let's look at the emerging market space. Again, I'll use iShares. And big players here, Europe would be China, Russia, India, not the entire part of the index, but the bigger players. And we go back 5 years, and you can see right here, 2021 was our market cap. And if you're looking back to try to say, where are we? We're back to where we were in mid 2019, sort of a sideways thing. Had a market top, had a couple of market bottoms, and just kind of doing a churn sideways. So again, hard to get excited about really jumping in with both feet and owning a lot of stocks in here right now, because we do not see a clear direction. All right, so the bond market, the most discussed part of the bond market would be the bond aggregate. It's Barclays now, it used to be Lehman Brothers, but the bond index pretty much has all of it in one particular index. And so this is an easy way to see sort of what the price, not the yield, but what the price of bonds has done over a 5-year window. So we were over here 5 years ago, made a market high right here. It was 2020. We've gone basically sideways. And now you see this big decline, and you go, what happened to bonds? Is there something wrong with bonds? Well, this is not a normal event. Let me put it to you that way. Basically, what you're seeing here is the culmination of low interest rate policies from the Fed for 10 or 15 years, which made that most of the bonds that sit in this index low yielding bonds. And then when the Fed raised interest rates, we started seeing the decline of the price, because these bonds don't raise their interest rates, but instead what happens is the interest rate on whatever bond was issued back here is still being paid, and the price adjusts to reflect that. So that's kind of where we're at, looking at where the markets are, and the bond market price is low, and you should see a higher yield. If we look, say, for example, at a 20-year treasury. So these treasuries in this index are basically set up to mature out about 20 years. Now, some of them are older and they'll mature sooner, but the vast majority of them are just, you should see this as a block of bonds that will mature in 20 years. Again, prices are way down. Yields have picked up a little bit. So this doesn't reflect what the new yields are. This reflects sort of the aggregate of what's in there in total. All right, so that's the bond market. We've done the international market. We've done the S&P, the NASDAQs, the Dows, and you're seeing what's happening there. We might take a look at the sectors. Now, this is not an easy thing to look at over here on the right, but really about 11 sectors in the U.S. economy, and consumer, discretionary, healthcare, utilities, so on and so forth. So if I were to look through, really the ones that have done really well would be communications, which has moved back up from where it was back about a year ago, but really looking at a line and saying, we're kind of where we were back in 2021, but way off of the lows from here. And then technology, these are the ones that are really working well. So if you look at tech, where is this one with S&P? Hang on. So XLK is that one. You can see technology has probably been the healthiest of these animals. Now you're paying a fairly high multiple for technology index, but these stocks always trade at a high multiple to their earnings. So nonetheless, if you're trying to look out into the future and say, what should I do? Right now today, you probably would, if you looked at some of the research that I read, think that the income side of things might be an easier place to navigate right now because of the short-term volatility since really the end of 2021, and not a clear direction for any upside outside of maybe the tech index that we're looking at here going forward. Nothing else has really done that good. If you look at utilities as an example, utilities have dropped off quite a bit, and we're really no better off than we were back right at the beginning of 2019, the end of 2019 and the beginning of 2020. Just nothing's really happening there. All right, so I'm not going to bore you with any more of this today, but as we look forward, stay tuned. If you have any questions about maybe positioning, would be happy to talk to you. Again, the phone number is 336-448-1086. And with that, I'll bid you a good October. Talk to you next month.